Hi everyone, it's Peter Schiff. It's Tuesday, December 21st, 2010. And as the year is coming to a close here, there's no shortage of pundits out there who are upping their estimates for the performance of the U.S. economy in 2011 and therefore being more aggressive in their recommendations to investors as to how they should play this newfound prosperity. And it seems to me very ridiculous for people to be jumping to these erroneous conclusions that the U.S. economy is going to have, a better good performance or robust economic growth in 2011 based on, very, very flimsy evidence. In fact, the only evidence that I can see people pointing to is the fact that we're not going to get major income tax increases in 2011, and therefore the economy is going to do very well. And they're also pointing to the increase in interest rates as somehow a sign of economic vitality. First of all, those are erroneous conclusions to jump to. Yes, income taxes are not going to go up in 2011, but the cost of government will. Therefore, government will be a greater burden on the American economy, the cost of that government in 2011 than it is in 2012. If we don't suffer that burden through income taxes, if we pay for it another way, it doesn't mean that that burden is not there. And of course, rising interest rates, rather than being a harbinger of economic strength, are actually a harbinger of weakness because we are very vulnerable as a nation to rising interest rates. And I think the rise in interest rates is only just getting started. I expect rates to go a lot higher, and that is going to be a drain on the economy. It's going to be a drain on the Treasury, which is going to be forced to pay higher interest on its debts. It's going to be a drain on individual American households who are going to have higher costs of debts. It's going to drain corporations who happen to be in debt. So it is going to be a headwind to the U.S. economy, not a tailwind. I think in general, people are always looking, particularly on Wall Street, for a reason to be optimistic. Politicians always want to try to put a positive spin on everything. But the reality is, if you look at the situation today, look at the problems not only of federal debt, but of all the states and municipalities, look at all the debts that students have run up through student loans, look at all the credit card debt, the auto debt. There is a mountain of debt out there, and there is nothing that has changed that would cause the economy to respond any differently than it has in the last several years. In fact, ultimately, if rates do rise, as I expect them to do, then all of a sudden we're going to have to pay a huge price for the bailouts and the stimulus of the last couple of years. One person who refuses to recognize this is Paul Krugman, who, once again has proven that if anybody should return their Nobel Prize, it's Krugman. I mean, he's certainly, I think, the most overrated economist today. And once again, he wrote an opinion piece in the New York Times trying to refute the Austrian economists or the free market economists by comparing them to zombies because he says that their ideology, their ideas have failed over and over again, yet they're still walking around with clout. And I mean, he couldn't be more wrong on this. First of all, one of the things in his op-ed that he claims is that the Clinton and the Bush years prove that tax cuts don't help the economy. He says that during the Clinton era, we raised taxes and we had a good economy. And during the Bush era, we cut taxes and we had, a disaster. Well, first of all, whether or not we had a good economy under Clinton is debatable. I don't think that we did. But the question is, did we have a good economy under Clinton because Clinton raised taxes? There's no correlation there. How do we know that we would have had an even better economy had he not raised taxes? Maybe had they cut the size of government, it would have been even more robust. The same thing for the Bush era. How do we know that had Bush not cut taxes, what if the economy did even worse? There's no relationship between those two. It's a coincidence. And the reality is, if Krugman understood what went on, the reason that we had this good economy under Clinton was because we had a NASDAQ bubble, a stock market bubble, and it didn't burst until Clinton left office. Bush inherited the recession that resulted from the policies of the Clinton administration. Now, what does Paul Krugman think Bush should have done in that 2001-2002 recession? I mean, after all, he would have been in favor of stimulus. Would he have wanted George Bush to raise income taxes during that recession? I doubt it. He would have been pounding the table, I'm sure he was, for government stimulus. But to somehow say, because the NASDAQ bubble didn't burst during Clinton's tenure, it burst on Bush's watch, and because the housing bubble burst on Bush's watch, that somehow this vindicates his position and invalidates free market principles, it's ridiculous. The problem is that both under Clinton and under Bush, we followed big government philosophies. We had a central bank that kept interest rates too low. We inflated first the stock market bubble and then a real estate bubble. And in both occasions, the government intervened along with the Fed to try to artificially stimulate the economy. In fact, the collapse of 2008, if it proves anybody's a zombie, it's the Keynesians. It's Paul Krugman's. We did exactly what Krugman wanted. In fact, Krugman actually advocated for a housing bubble. When the stock market bubble burst, he's on record as saying the Fed needed to lower rates so that we can get housing prices to rise to offset the drag from the falling stock market. He's the zombie. He's the one that's walking dead. The fact of the matter is, the guys that are advocating free market philosophies, like me, the Austrians and we're the ones that have been right. We have been consistently right in our forecasts about what would happen if we followed these Keynesian models. Yet it's the Keynesians that close their eyes and refuse to acknowledge reality. You know, one other thing that Krugman points at is Ireland. And it says, oh, you know, all the Austrians, all the free market people, Ireland was the poster boy. You loved Ireland. Now look at the mess it's in. Ireland is not in trouble because the Irish reduced corporate income taxes and attracted businesses from all around the world. Ireland is in trouble because they kept interest rates too low. Ireland is in trouble because when the banks failed, when Anglo-Irish Bank failed, the government bailed them out. A free market Austrian wouldn't have done that. And in fact, how can you look at Ireland and then ignore Greece? I mean, Greece is not a bastion of free market capitalism, and look at the mess that they're in. Anyway, you know, one more thing I wanted to talk about. I'm reading a lot again as the year is coming to an end about the gold bubble. Stay away from gold. Oh, it's a bubble that's going to burst. The small investors are going to get killed. You know, again, the people that see gold bubbles miss the housing bubble, miss the stock market bubble. This is not a bubble. Gold's rise is real. It reflects a permanent diminishment in the value of the dollar. Gold is just measuring the value of our money. We're all printing money. The Fed is creating dollars. The dollar is losing value. So the price of gold has to rise to reflect that. Has nothing to do with the bubble. You go back to the 1970s, right? The price of gold went from $35 an ounce at the beginning of the decade to $800 at the end, right? A 23-fold increase. Now, 800 clearly was overvalued, and it did collapse. Gold prices dropped from 800 back to, they settled into a range between 300 and 500 for about the next 20 years. So let's call the average price after gold hit 800, 350. It did go above 500 briefly. It went below 300 briefly, but most of the time it was about 350. So if you bought gold at $35, even after the bubble burst, it was still 10 times where the bull market started. Well, where are we now? Gold's at about $1350. The bull market started at $250. If we have a repeat of the 1970s, this market will top out around 6,000, 5,700 to 6,000. Then gold will eventually fall and settle back down at around 2,500 an ounce, which is still more than twice the current price. And I believe that the economic fundamentals are so much worse for the U.S. economy, and we're going to debase the U.S. dollar by a much larger amount than we did in the 1970s, that we can have an even more spectacular rise in the price of gold. And yes, there's no doubt in my mind that eventually the rise in the price of gold will attract speculative money, and it will eventually overshoot, and then we'll have a substantial drop. But as far as I'm concerned, we are nowhere near that point yet, and the fact that so many people are worried about it and warning individual investors to stay away, this is a big sign that you keep buying. And I take comfort in the fact that the people who are so clueless are so sure about the one thing, and that's that gold's a bubble and about to burst. Anyway, that's it for today. If I don't blog again, have a Merry Christmas, everyone. Take care.